Last week, Jerome Powell gave a speech at the Fed's annual conference in Jackson Hole in which he indicated that rate cuts are coming very soon. Powell said that the balance of risks across the economy had started to shift, which is raising the odds that the central bank will lower borrowing costs at its next meeting in mid-September. His speech resulted in stock prices soaring, with the S&P 500 growing 1.5% and the NASDAQ 100 also surging 1.5% over the day. The S&P is now trading at its all-time high, and the NASDAQ is also very close to its all-time high. Obviously, the market responded very positively to the speech, as we've all been hopeful for rate cuts for a while. Now that we have even stronger evidence that interest rate cuts are coming very soon, now is a good time to prepare for when they do go into effect. Although the majority of high-yielding investments are better positioned to do well when rates are falling, there are some that are likely to go through dividend cuts as rates fall. So in this video, we're going to take a look at some of those high-yielding investments that you can expect to see dividend cuts from. Unless you have some kind of conviction or you're willing to accept a dividend cut in the short term, then now is a good time to rotate out of these investments. The first type of holdings that high-yield investors should consider avoiding right now are floating rate debt ETFs and closed-end funds. These are funds that primarily hold any kind of assets that pay a variable rate, basically floating debt investments. There's a lot of these funds that exist, and there's several variations in terms of what they're called. Most are referred to as floating rate debt funds, but some are also called floating rate bond funds, but they're basically the same thing. You'll have to check the names of your funds as well as what they hold to see if they rely a lot on floating rate debt investments to cover their distributions. The reason why these investments should be avoided is because they earn less when rates go down. This translates into less money being earned from these debt investments to pay shareholders their dividends, and as a result, dividend cuts are very common with these holdings. We can look at a number of these funds, and if they've been around for at least 20 years or so, then you'll see dividends get cut right when interest rates start going down. The Nuveen Floating Rate Income Fund, ticker JFR, is a good example of this. It's been around since 2004, so it has a long track record that we can look at. On the surface, this closed-end fund looks really appealing. It currently offers a yield of over 12% and it pays monthly distributions. But when we look at its dividend history, what you'll notice is how much it pays in dividends is largely influenced by the federal funds rate. That's because with this fund, at least 80% of its managed assets will consist of adjustable rate loans. We can see that between 2007 and 2008, JFR experienced a lot of dividend cuts. Its distributions also fell in 2020, only to rise in the following years. If we compare this history to a chart of the federal funds rate, we'll see that they obviously correlate with each other. When rates go up, then dividends go up. When rates fall, then dividends get cut. The same is true for other floating rate debt funds. This is the BlackRock Floating Rate Income Strategy Fund, ticker FRA. Its dividends are identical to JFR and the federal funds rate. You might also notice that when there's only slight interest rate cuts, then these funds don't experience dividend cuts. If the cuts we get from Powell are going to be very small, then it's possible these floating rate funds might not be too negatively impacted. But in the long term, I would be concerned about their distributions. These funds are the pure definition of cyclical investments. I'm sometimes asked over on our Patreon what my opinion is on these floating rate funds, and I tell people that they are great investments when rates are flat or rising. But when interest rates start going down, then they'll be negatively impacted, unlike most high-yielding investments. So I'm not a fan of holding these investments for decades, but if you are willing to rotate out of them, then they can be good investments during certain times. Also, what I've been talking about up to this point does not include fixed debt investments. ETFs and closed-end funds that exclusively hold fixed debt are not going to suffer the same way as floating rate funds. Another type of high-yielding investment that I would strongly recommend dumping is low-quality business development companies. As I talked about last week, when we do get rate cuts, BDCs in general are going to be dealing with a more difficult environment. This is because most BDCs hold an overwhelming majority of floating rate debt in their portfolios. Just like with the floating rate funds, the amount of income these BDCs earn from this debt depends on interest rates. When rates go up, they earn more income from their portfolios. When rates go down, then investment income falls. The business development companies that are already struggling right now, even before we start getting rate cuts, should be sold off in my opinion. Unless for some reason you hold one of these companies and you strongly believe they're going to make a turnaround, I would not consider buying or even holding any of the following. One of the absolute worst in this sector continues to be Prospect Capital, ticker PSEC. I've been following this company for many years and it's continued to go downhill. Today it's now a penny stock and it's collapsed 43% in just the last year. It's gone through so many dividend cuts over the years, and it's likely heading for another as their dividend coverage is only going to get worse. Monroe Capital, ticker MRCC, is another BDC that's heading for a dividend cut. They reported a really disastrous quarter not too long ago, and their dividend coverage was already being stretched thin. Their current dividend payout ratio is 166%, indicating their dividend is very unsustainable. And when rate cuts go into effect, it's only going to suffer much more. PennantPark Investment Corporation, ticker PNNT, and not to be confused with PennantPark Floating Rate Capital, is also doing very poorly right now. PNNT hasn't covered their dividend in well over a year, and with interest rate cuts coming, things are only going to get more difficult for this company. Horizon Technology Finance is another BDC that I would be very cautious of owning. Their dividend coverage isn't as bad as the others we've looked at, but they're still not currently covering their distribution. Their NAV has been collapsing pretty hard, which would indicate a failing portfolio, and it also explains why their stock's share price has been collapsing this year. For Dividend Bull Access tier members on Patreon, if you want to learn how to analyze BDCs and determine the safety of their dividends, I just published a 38-page guide on how to analyze a BDC. It covers all of the most important metrics that you should look at, including dividend coverage, NAV, spillover, and more. It guides you step by step on how to find all the information, as well as how to interpret it, so you'll know how well your favorite BDCs are doing. It's available now for Dividend Bull Access members. You might be wondering, since conditions are going to get harder for BDCs because of all this floating rate debt, wouldn't it be better to just sell out of all BDCs? Why consider selling out of all floating rate debt funds but not BDCs? And the reason why BDCs are still worth holding on to is because they can better manage their portfolios. Floating rate debt funds will buy pools of pre-existing debt from financial institutions, whereas BDCs issue the debt themselves. They have a lot more control over who they lend to, and they can provide better due diligence when issuing debt. So it can be safer if the BDC has a solid track record, and plus BDCs can use strategies that ETFs can't. So that's going to wrap up our look at some investments that are likely to go through dividend cuts due to interest rates. The good news is that most high-yielding investments can do better when rates go down, but there is a really important thing to keep in mind. The whole reason the Feds will cut interest rates in the first place is because they believe the economy is going to slow down. So although rate cuts are good, they can also be cut due to worsening economic conditions. But I am hopeful because we're very unlikely to see aggressive rate cuts, which would indicate a serious problem with the economy. But feel free to let me know your thoughts in the comments. But with that being said, that's going to wrap up today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.